All right. Thank you all for tuning in to WJCLP 98.3 FM Chicago. And welcome to the show Money Talks, where all we talk is money. And I'm your host, Jeff Badu. I'm a parallel entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprises, LLC, which is a multinational conglomerate in the finance industry. And essentially what we do there is we provide a suite of financial services, including our marquee company, which is Badu Tax Services. And that's the firm that does tax preparation, tax planning, and tax representation for individuals and businesses across all 50 states in the U.S. And we also have clients in over 25 countries at the moment. Then we have Badu Investments, LLC, which is my real estate investment company. And what we do there is we invest in apartment buildings, mainly on the south side of Chicago, in efforts to restore traditionally underserved communities. Then we have Badu Life and Health Solutions, LLC, which is our life insurance agency, and that provides life insurance products and solutions to individuals, families, and businesses. And then last but not least, we have the Badu Foundation, which provides financial literacy education to the youth ages 6 to 18, where we teach them on topics such as budgeting, saving, investing, and scholarships. All right. And for me, my purpose in life is to inspire and support the super hungry to take hold of infinite resources in order to create an abundant lifestyle. Once again, thank you for tuning in to WJCLP 98.3 FM Chicago. We're live on the radio today, 98.3 FM in Chicago. You can also check out our website at WGHCradio.org. We're also streaming live on Facebook, so Facebook straight ahead. We got Instagram as well. So if you don't mind, as usual, if you can share the video, and also drop in the chat where you're listening from so that we can give you a shout out. All right, shout out to everybody that's listening today. Shout out to Koyuma. He just bought a badge on Instagram. So shout out to him for buying a badge on Instagram. Definitely appreciate that. All right, so today we're going to talk about something very important. We'll probably use the full hour today because there's a lot of details in here. And I really want everybody to pay attention to some of the proposed legislation behind the Biden tax hikes. Right? Biden tax hikes, essentially. And so basically we have a $3.5 trillion bill on the floor, essentially. Right? $3.5 trillion bill on the floor. And with that being said, you know, this is the Biden tax hikes, essentially, right? The Biden tax hikes. And so with that, let's go into the market report. So this report is as of September 24th, 2021. And with that, investors rode a bumpy ride. It was very, very bumpy last week. And it's been very bumpy today as well. Opening last week lower only to rebound later, but not enough to avoid a third consecutive weekly dip. So the stock market has gone down 3 weeks in a row now. We may experience a fourth week. All right, so just something to keep in mind. Only the NASDAQ, which is composed mainly of technology stocks, by the way, was able to avoid closing the week in the red, but barely. The Dow and the Global Dow fell nearly 1%. While the S&P 500, which is composed of the top 500 companies or stocks in the U.S., and the Russell 2000 declined more than 0.8%. Traders were able to overcome concerns early in the week of the possible financial collapse of a major Chinese property developer. Only to learn last Friday that Chinese regulators will now consider crypto-related transactions illicit financial activity, aka illegal. All right, Wall Street suffered. Let's start on Monday. All right, let's see what happened Monday. A lot of stuff going on last week. A big roller coaster ride in the stock market. So last Monday, all right, basically everything fell. Everything was in the red. Russell 2000 went down 2.4%. NASDAQ went down 2.2%. Dow went down 1.8%. S&P 500 went down 1.7%. Global Dow went down 1.7%. I mean, it was bad. And the number one reason for that, as silly as this is about to sound, It was literally one company. One company controlled the stock market last Monday. And you may have never heard of this company, actually. And that company's name is Evergrande. Evergrande. It's a Chinese-based real estate developer. And basically, they failed to pay on a debt. Millions of dollars worth of debt. They basically missed the payment. And so people got scared. Usually what people do, they panic. They sell like crazy. Oh, another Lehman Brothers. Oh, another 2008. Of course, not using logic or actual sensible information. They just go off emotions. And so basically what happened was a lot of people started selling their stocks because this one company in China, not even a U.S.-based company, but a company in China called Evergrande, a real estate developer. So the stock market went down last Monday because of one company in the stock market and because of the fact that they failed to pay their debt payment on time. Right? Of course, what will happen, the government will probably bail them out because they don't want turmoil. So always understand, we don't trade stocks. You shouldn't be trading stocks with emotions. Oh, everything's going down, so let me sell. No, absolutely not. It's buy low, sell high. All right, buy low, sell high. Not the other way around. It's not buy high, sell low. It's buy low, sell high. And so what people were doing on Monday is they were buying, basically they were selling low. They were selling low. When prices were going down, they kept selling. And that just kept continuing. And then Tuesday, the NASDAQ and the Russell 2000 actually went up 0.2%, so a little higher. But the Dow and the S&P 500 went down, so it went down a little bit. So we started recovering a bit. By the way, the same thing that happened last Monday happened today as well. Literally, the same exact thing that happened in the stock market last Monday happened today, where it went down by about 4, basically it went down a decent amount. At least some of the major companies went down. And it's mainly due to this company in China called Evergrande. Right, Evergrande. Stocks closed mixed last Tuesday, while the NASDAQ and the Russell 2000 edged higher. All right, so remember, last Tuesday it was a little mixed. Let's talk about Wednesday. Man, we'll get into the topic here. Don't worry about that. We'll get into the topic by 7:15 p.m. Central. So if you want to get some water, get a notepad, whatever it is, then feel free to do so. All right, last Wednesday, the Dow, the S&P 500, and the NASDAQ each rose by at least 1%. So they each rose by at least 1%. The Russell 2000 led the indexes, gaining 1.5%, while the global Dow advanced 0.8%. All right. Investors may have been encouraged by potentially favorable developments involving Evergrande. Also, the Federal Open Market Committee, FOMC for short, was guardedly bullish on the growth of the economy. So that gave investors more confidence. Anytime the Fed says, hey, the economy is doing well, right? Even if it's not. Indicating that a tapering of its asset purchasing may begin soon, but that interest rates would remain at their current level for quite some time, which is good news, meaning investors can borrow money at cheaper rates so that they can buy more stocks, they can buy more assets. By the way, one thing to note about wealth is that wealth is truly debt in a way. It's kind of crazy to say, but if you think about the U.S. government, it's actually fueling off of debt, right? It's fueling off of debt. Now, a savvy investor, I don't know if I would consider the U.S. government a savvy investor, but a savvy investor knows how to use the debt, which is basically wealth, in order to essentially, use that to their advantage ultimately, right? A savvy investor knows how to use debt essentially to boost their wealth, right? So once again, a savvy investor knows how to use debt in order to ultimately boost their wealth, right? So just something to think about over there. All right, so last Thursday, investors were buoyed by the Fed stance on paring stimulus. The FDA, Food and Drug Administration, basically they authorize a Pfizer booster vaccine for those aged 65 and older, and an easing of concerns over the ripple effect of an Evergrande default, right? This whole Evergrande thing, it just keeps messing up with the market, essentially. All right, so what happened there? Let's see. Pretty much everything went up. And then Friday ended the week with mixed results. The Dow went up 1%. S&P 500 went up 1%. And then the global Dow went up 0.8%. NASDAQ did dip a little bit. All right, so overall, last week in the market, the Dow Jones went down 0.94%. So far this year, it's up 11.93%. The NASDAQ is up 16.75%. The S&P 500 is up 17.03%. The Russell 2000 is up 12.34%. The global Dow is up 13.60%. And interest rates are still at 0%. So there's plenty of important economic data available the last week of September. Orders for durable goods, September being the final month of Q3, by the way. Orders of durable goods slipped in July, but are expected to rebound in August. The third and final estimate for second quarter GDP, gross domestic product, is also out this week. The economy expanded at an annualized rate of 6.6%, according to the second estimate. So the final estimate, the third estimate, is coming out this week. All right, so that was a lot. Long story short, you should be invested in the market. If you're not, take advantage of these, of these moments where people are using emotions to make investment decisions, and instead you can use logic, sensible information to be able to essentially make a profit. All right, so just something to think about. All right, so if you're just now tuning in, welcome to my show, Money Talks, where all we talk is money. We're live on the radio, WGHC LP 98.3 FM, Chicago. Once again, WGHC LP 98.3 FM, Chicago. Just a reminder, you can check out our website at WGHCradio.org. Once again, that's WGHCradio.org. You can actually listen. There's a tab called the Listen Live tab. We're also on Facebook. And we're on Instagram. So we're on Facebook, we're on Instagram. And you can feel free to like and share this video. Right? It always helps get this information out to more people. And then you can feel free to drop in the comments where you're listening from today. Just drop in the comments where you're listening from today. All right. So with that, let's talk about the Biden tax hikes. You might have heard on the news about an infrastructure plan, but also what you might not be paying attention to because it's not heavily promoted is that there's a big tax reform coming by the end of this year. You're right. You heard that right. 2021. All right. Shout out to Pastor Kwame. He says he's listening from Chicago. Shout out to Chicago, Chi City. All right. So today, what I'm going to do is I'm basically going to read a lot of text. So I'm actually going to read a lot of text. But I'm also going to break it down a little bit and explain to you what some of these things mean. I will skip over some of these items because I don't feel those are too important. All right, Perry says he's listening from Chicago. Shout out to Chicago. All right, so this is the House and Ways Committee release. This was the initial draft of the reconciliation bill. And this was released around September 15th, give or take. So a few weeks ago. All right. Call your minds listening from LaGrange. Shout out to LaGrange. All right. So Chairman Richard Neal, who's a Democrat out in Massachusetts, and the House and Ways and Means Committee, right, have released the initial draft of their portion of the reconciliation package that aims to fund $3.5 trillion in new spending. When the government spends money, they need money from somewhere else to be able to replenish it or be able to sustain that spending. So where are they going to get the money from? Of course, taxes, right? They need to hike up taxes. This is why we call this the tax hikes reform. You've been getting stimulus checks. You got PPP, EIDL. Well, where do you think they got the money from? They didn't just pull it out of thin air. I mean, they were printing money in the back, but they need a way to replenish that money. And in order to do that, they need to hike up taxes, which, of course, the Republicans don't like too much because they tend to be, on the wealthy side, and they don't want to pay taxes. Wealthy folks are known not to want to pay taxes because who would want to pay taxes anyway, right? And that you can just take your money, invest it, deploy the capital in whatever you deem as meaningful, as for investment or charitable purposes. Why should the government be in charge of controlling that? All right, so many provisions will be effective with the 2022 tax year, so next year. Here are some of the biggest ticket items included as revenue raisers to pay for the package. All right, so if the government wants to spend $3.5 trillion, they need to raise enough tax revenue to be able to pay for that. All right, so now let's start with the business stuff, and then we'll go to the individuals. So if you're a business owner, you definitely want to pay attention to this part. So the top corporate tax rate will increase starting in 2022 to 26.5% on income above $5 million. Income up to $400,000 will be subject to a lower 18%. So that's pretty good, right? Right now it's at 21%. So the current 21% rate would be unchanged for income between $400,000 and $5 million. You may have heard, but they're really targeting those who make above $400,000 in this tax reform. So if your W-2, if your net business income is $400,000 or more, you're definitely going to be impacted by this tax reform. So they're thinking about increasing the corporate tax rate because the corporations make all the money. By the way, the corporations will simply find a loophole around that. They'll probably put some money in the Cayman Islands, right? They'll put it in the Bermudas. They'll put it overseas, Puerto Rico, and they'll keep not paying taxes. What happens in this case is the money will be stuck overseas in these offshore accounts that the U.S. won't have access to, and instead these islands basically will have all the money. They have a lot of tax benefits because they want tourism. They want people to be storing money there. That way they can invest it and they can make more money off of that money. That's why I say money is debt. When you give money to a bank, it becomes debt to the bank, and that bank turns around and turns that debt into another debt. They go to the Federal Reserve and they get a loan for 10 times your money at 0% interest, and they go out and loan it to you in the form of a credit card, a home loan, a business loan, a line of credit, and they make money off your money. You don't even know it. So money, in a way, is debt. Wealth, in a way, is debt, in a way. That's how, wealthy people keep getting wealthier, is they borrow money at lower interest rates. They invest it at higher interest rates. It's real simple. It's called the arbitrage game. All right? Shout out to Andre Harris, listening. He said, yo, Jeff, what up, my brother? Definitely appreciate you for listening, Andre. All right, so let's go into the next one. This next one might not apply to some of you, but personal service corporations will not be eligible for graduated rates. All income will be subject to the 26.5% rate. Not too important, so we won't even talk about that, what that means, actually. It's a little too complicated anyway. The benefits of the graduated corporate rate will be phased out by an additional 3% tax on corporate income above $10 million, up to a maximum additional tax of $287,000. I mean, can you imagine if Amazon was to read this? You're telling me all I gotta do is pay an extra $287,000 in taxes? I mean, this is a joke, right? It's a joke. So nothing too important there. Amends IRC Internal Revenue Code Section 163J to apply the interest limitations at the partner or S corporation shareholder level rather than at the entity level, with items passing through to the owners. Doesn't really mean anything to you. Limits the carryover of business interest deductions disallowed under the IRC Internal Revenue Code. So IRC Internal Revenue Code stands for IRC, basically. Section 163J to 5 years on a first in, first out basis. Also doesn't mean much to you. effectively increases the rates on both GILTI and FDII income through reduced deductions and exemptions. Also doesn't mean much to you. So I'm only going to elaborate on the relevant ones. All right, requires country-by-country treatment of foreign tax credits and GILTI income reporting. So if you have foreign assets, you earn income overseas, then that might apply to you. But we won't touch it because it's not too relevant for a lot of people listening right now. All right, moving on. Let's see. Subjects non-resident aliens to 30% withholding tax for interest income received from a company in which they own at least 10% of the interest. This might be a big one. Non-resident aliens, meaning non-U.S. citizens or non-U.S. based companies, they're subject to a 30% withholding tax for interest income that is received from a foreign company, basically. All right, so increases the required holding period on carried interest from 3 years to 5 years in order for amounts received on such interest to receive long-term capital gain treatment. Basically, they want you to hold things for a longer period of time. They want you to hold your investments for a longer time, which you should be doing anyway. If you have an investment, you should be holding it for a relatively decent amount of time. Let it grow, let it beef up, let it do its thing, let it keep growing. Right? And then when the time is right, you go ahead and take the money out however way you need to. And what you can do nowadays is you can leverage debt. You can literally pledge whatever that asset is as collateral, get a loan from a bank up to, let's say, 90% of the value of that collateral, and now you have cash that's just sitting there. You have this asset that's pledged as collateral, meaning you didn't have to sell it, which triggers a capital gains tax. Instead, you took out a loan on it, which is still cash, which you're going to be paying interest on, but you're saving on taxes. And what do you use to pay it back? Whatever you took the money and invested into, let's say a real estate rental property, you let your tenants pay back the interest on the debt that you just took out. I mean, this is how the quote-unquote rich get richer. They learn about these things. They use debt to their advantage at low interest rates. Interest rates are stupid low right now. They use debt at low interest rates, and they use the income or revenue generated from the investment to pay off the interest. And they keep what the difference, the arbitrage in between. Once the loan is paid off, guess what? They still have the asset that was growing or that they leveraged up to the 90%. They still have that and the new asset that they acquired. Can you imagine? This is how you create wealth. And that asset that they leveraged at the 90% is still going up in value. Right? It's still going up in value. This is similar to life insurance. This is similar to real estate. When you get a home equity line of credit or when you refinance, right? When you take out a loan against your life insurance policy, or you take out a loan against your business. I mean, it's insane how much stupid wealth you can build tax-free at that. Everything I just talked about, you don't have to pay taxes on it either. Right? You don't have to pay any taxes on it because you can utilize something called a depreciation tax deduction on your real estate on any profits that you're earning either in the real estate or in other business ventures. I know that was a lot, but when you learn the rules of the game, the rules of the wealthy, you'll notice that they suck up a lot of debt. But then when you also look at their balance sheet, the asset column is huge, it's ginormous. So they have a lot of debt, but they have more assets to be able to pay off that debt. And when the debt is paid off, they still keep the asset, the old asset, and the new asset. So now they just accelerated their wealth versus someone who may be buying things with cash, who's not doing any leverage. Not only do you lose the cash, right, which you could have done other things with, but you also don't get as big of the tax benefits. You don't get, you're not able to take advantage of that arbitrage of the debt. So it's crazy some of these things you learn. And for me personally, by the way, I do the same thing when I learn these things. One thing about me personally is when I learn something that I believe is, like, sounds good, even if it's quote-unquote too good to be true, I say, hey, what do I have to lose? If it's too good to be true and it fails, hey, it fails, right? What if it's not too good to be true? What if it is just that good? So one thing I always encourage people is change your what ifs to why nots. Like, why not do it? Why wouldn't you do it? Right? Instead of asking yourself, what if you ask yourself, what if, you'll be a what if man for the rest of your life, a what if woman for the rest of your life. You'll go to the grave being a what if person. But when you change your what if to why not, take some risk, calculated, of course, calculated risk, then look how much you can achieve in life. Think about how the wealthy became wealthier. They do the same thing. Same thing, right? All right, so let's move on to some additional things within this tax reform that will hit by the end of this year, by the way. Don't let it be a surprise. The tax reform is coming. The tax reform is coming. It's just a matter of time. Remember, the Democrats basically control Congress. So this is a Democrat bill right here. And it will get passed by the end of the year. It will be effective next year. Possibly some things retroactive for 2021, which is a little scary, by the way. But nonetheless, let's keep going. All right. So another thing here is it bars taxpayers with adjusted gross income, AGI, greater than $400,000 from qualifying for the 75% or 100% exclusions for gains on qualified small business stock under Section IRC 1202. This is big, actually. This is big, but it's a little too complicated to explain over the radio, so let's go ahead and skip that one for now. It expands the constructive sales rules of IRC Section 1259 and the wash sale rules of IRC Section 1091 to digital assets and currencies, aka Bitcoin. So they really want to crack down on Bitcoin, cryptocurrencies, and the whole wash sales. Basically, you can't sell something at a loss and then buy it right back and basically take advantage of that tax deduction. Right? They don't want you to be doing that arbitrage. So that's what's called a wash sale, essentially. You basically sold it for a loss, and then you bought it right back within 30 days of selling it. All right. So it disallows deductions for conservative or conservation easements. Oh, my goodness. Conservation easements made by pass-through entities, syndicated conservation easements, where the value of the easement exceeds 250% of the partner's aggregate basis in the partnership that relates to the property, with certain exceptions applicable retroactively to contributions made after December 23rd, 2016. That was a whole mouthful. Basically, conservation easement is when someone has a land preservation that they've invested into. Believe it or not, the U.S. is running out of land, and so what they can do is they can restrict the use of a land, and they can allow somebody to invest in this. They get a tax deduction at, let's say, 200, 300% of the value. So they're saying if it's above 250%, which is still a pretty nice tax deduction, you mean to tell me if I give you $1, you're going to give me $2.5 back in tax write-offs? I mean, that's unheard of. Like, literally, this is true right now. You can give me a dollar. Let's say you gave me $1, and I gave you $2.50 back in a tax deduction known as a conservation easement. Right? Basically, you invested into land that's preserved for use, for maybe doing a study on, I don't know, forest fires, right? Whatever it is. So you're basically conserving the land for a specific purpose. So imagine if you gave me $1 and I gave you $2.50 back. Doesn't that sound too good to be true? Right? But it's not too good to be true. People do this all the time. Right? It may be too good to be true to your ears because you've never heard it before, and your mind is not advanced or expanded enough to think that further. But people do this all the time. So the way it works is you contribute $1. Let's say you contributed $100,000 into a conservation easement. You can get a tax deduction of up to $250,000. A tax write-off. $250. You gave me $100, you got a write-off of $250 just by investing in an easement. Right? And that easement, how does the fund make money? They can sell the easement to somebody else or to whoever it is that wants to do the intended purpose of the land with. Right? So, I mean, it is pretty complicated, but they're capping it at 250% benefit, basically, which is still pretty nice. I mean, I have some clients that are earning 400% return on their money right now. It's crazy. It's crazy. All right, but moving on. accelerates the termination of the employer credit for paid family and medical leave to 2023 rather than 2025, which is good. The pandemic has been extended, and so they want people to be able to pay their employees for just coming back out to work. All right, shout out to Mr. Marshall, right? He probably heard something real good as it relates to this conservation easement tax strategy that we can certainly chat more about. All right. It will allow certain S corporations to reorganize as partnerships without triggering any tax if done in 2022 or 2023. All right. It extends the FICA tip credit to tips received in providing beauty services to a client or a customer. Don't know exactly why they chose beauty services, but I can imagine it has something to do with COVID-19 significantly affecting the cosmetology or beautician industry. It increases the work opportunity credit for targeted groups other than summer youth employees to 50% of the first $10,000 in wages from date of enactment through the end of 2022. So what I'm hearing here is that it's encouraging people to work, basically. They're giving incentives for those who want to go to work, who actually want to stop collecting unemployment and go out and work. And it's incentivizing employers to retain those who really want to work, which is good. I think that's a good thing. It definitely helps stimulate the economy. It delays the amendment to IRC, Internal Revenue Code, Section 174, that would require research and experimental expenses to be amortized over 5 years rather than deducted from January 1st, 2022 to January 1st, 2026. All right, so basically, you can get a deduction for research and development. So there's actually a credit for research and development. And so instead of it being amortized over 5 years, they're looking for you to be able to deduct it in full, to keep doing that. All right, which is good. That's a good thing. That's definitely a good thing. All right, so basically, that means that you can get your tax credit for doing more research. They probably want you to be more thorough in your research so that you can be able to get a deduction. All right, shout out to Dion Landry, listening all the way from Chicago. Shout out to Dion. All right, so that's some stuff that affects the businesses. Now, to something that might relate more to you as an individual, it creates a new top tax bracket of 39.6% for income over $400,000 or $500,000 for joint filers, $450,000 for head of household filers, and $225,000 for the married filing separate filing status. All right, so you might want to consider filing jointly if you file in this bracket. So basically, right now the top tax bracket is 37% for individuals. So it would increase that to 39.6%, which was what it was in the Obama days, right? And basically, that's going to hike up taxes for those who earn over $400,000. Remember, this bill is really targeted to those that earn $400,000 or more in either W-2 income or net business profit. It creates a new 25% capital gains tax rate for taxpayers with income that fall into the new 39.6% income tax bracket, effective for gains recognized after September 13th, 2021. 2021. That means the date has already passed. That's kind of scary. Meaning that if your tax bracket is 39.6%, mean you make over $400,000 a year, then your capital gains tax rate goes up from 20% to 25%. I mean, that's massive. So you might want to do a 1031 exchange if it's still allowed, of course. But let's keep reading. Let's see what happens here. It applies a net investment income tax to ordinary trade or business income of taxpayers with taxable income over $400,000 for individuals or $500,000 for joint filers, with an exception of wages subject to the FICA tax. Not too important, so we won't expand on that. All right, next one on the list. It caps the allowable qualified business income deduction, we call this QBI, under Section 199A to $400,000 for an individual and $500,000 for joint filers, half that if married filing separately, and $10,000 for a trust or estate. All right. So which is good. That's actually good news. It increases a limit of a 20% automatic tax deduction that small business owners can get. So I believe they're incentivizing people to start a small business. All right. So wink, wink, right? Wink, wink there. It permanently disallows excess business losses, eliminating the original sunset of disallowance at the end of 2025, provides for carry forward of disallowed losses to future tax years. All right. Which is bad, by the way. From what I interpret, that means that no more net operating loss. So if your business made, let's say, $100,000 in profit last year, 2020, right? And then you lost $50,000 this year, then basically what it's saying, if I'm reading it correctly, is that you couldn't use the $50,000 to offset the $100,000 that you earned in the past, right? The net profit. So I think they need a little more clarity on that because it does sound a little confusing. It says that it provides for carry forward of disallowed losses to future tax years, so you can carry it over. I think they tried to get at Donald Trump for this one because for those who don't know, Donald Trump was basically able to take a loss he had in the business and apply it in the past, right? He was able to apply some stuff in the past and also into the future. So they're saying that you can still apply the loss in the future, but what it sounds like is you can't apply it in the past. You can't apply profits that you've already earned. Maybe it's going to throw off the IRS budget. I don't know why they did that. So just something to keep in mind. It adds a new IRC Section 1A, providing for a 3% surtax on income over $5 million. So if you make over $5 million a year, God bless you, by the way, then you get a surtax of 3%. By the way, one way to avoid paying income taxes altogether is to reinvest your profits into income-producing assets such as real estate. Meaning that if you are making $5 million a year, let's say in profit for your business, you could very well reinvest that $5 million or a large handful of it into an income-producing asset such as real estate. Excuse me. So those are some of the provisions when it comes to the tax reform for individuals. Now let's look at retirement savings. This is a big one too. It prohibits any additional contributions to IRA accounts if the aggregate balance of all IRAs and defined contribution accounts, such as 401k plans, exceeds $10 million if the taxpayer has taxable income over $400,000. So if you're sitting on something nice, if you got 10 mil sitting in an IRA account, then you can't put in any more money if your income is above $400,000, right? At least into an IRA account. Of course, there's other accounts. There's life insurance, right? This might be an opportunity to redirect some funds into other investments, such as life insurance or 401k or real estate, right? Cryptocurrency. There's so many investments out there. So I don't know where they're really getting at with that. I don't think it makes much sense. Maybe they don't want people to shelter too much tax in an IRA account. All right, so, and then with that, it requires annual minimum distributions from retirement accounts if the aggregate account balances exceed $10 million of 50% of the balance in excess of $10 million. Don't know what that means, to be honest, but I'm sure they'll find out more. They'll release more information. If aggregate retirement balances exceed $20 million, it requires the taxpayer to distribute 100% of any excess with Roth IRAs and Roth accounts in 401k and other defined contribution plans being required to be distributed first. So if you have 20 mil, right, 20 mil, you're sitting on 20 mil in a retirement accounts, qualified retirement accounts, not including life insurance, by the way. It sounds like they didn't even touch life insurance on this one. But if you have 20 mil sitting in traditional or retirement accounts in general, then you have to pull out, right? You basically have to pull out anything in excess of $20 million. With Roth IRA, the good news is you can take out after-tax money first, Roth IRA, so you don't get hit with any taxes. It prohibits Roth conversions of after-tax contributions to qualified plans beginning in 2022, eliminating so-called backdoor Roth IRAs. Oh my God. This one is a slap in the face. So backdoor Roth IRAs would no longer be allowed, or backdoor Roth conversions for higher income taxpayers who are taxpayers that make over $400,000 in income in a year, beginning in 2032. It sounds like a typo. So I'll call that a typo. Let's say 2022. Sorry. That should not say 2032. It would make no sense. 2022. So basically, if you make over $400,000 in a year, then you cannot do a strategy where you're contributing to a non-deductible traditional IRA account and you're rolling the money over into a Roth IRA account. We call this a backdoor Roth IRA account, where you're basically screwing the system legally. You're legally screwing the system by moving money from a traditional IRA account to a Roth IRA account because you were not qualified to get deductible, or you were not qualified for a traditional IRA account because your income was too high. Right, so there's income limits on a traditional IRA account. It prohibits an IRA from investing in an entity in which the account holder owns more than 10% of the interest, unless the interests in the entity are publicly traded, or in which the account holder is an officer or director. To be honest, this is already the case anyway, so I don't know why they would say this. Right? This is known self-directed IRA accounts, for those who don't know. Basically, if you own more than 10% in a company that you own maybe in your name, you cannot partner with the IRA, where the IRA becomes an owner and invests with you. They call that basically self-dealing, essentially. Prohibited transaction. All right. So a few other things. These definitely won't apply, but I want to mention it anyway. Transfer tax provisions accelerates the sunset provision applicable to the estate and gift unified credit, returning the exemption equivalent to its pre-Tax Cuts and Jobs Act, the Trump administration, $5 million base to be adjusted for inflation in 2022 rather than 2026. All right, so they're bringing back the maximum exclusion amount for passing assets down to beneficiaries. Right now it's about $10 million. Right, it's about $10 million. And they would bring it back down to the $5 million. So right now, if you passed away, God forbid, you can transfer $10 million to your beneficiaries income tax-free, estate tax-free. Right, at least at the federal level. Illinois has a 16% tax on anything over $4 million. So basically, the feds will bring it down to $5 million from $10 million. And so now you can only transfer $5 million to your beneficiaries tax-free. A way around this, you set up an irrevocable trust, and you move your assets into this irrevocable trust, which offers some very tremendous tax benefits and also avoids probate. It requires the inclusion of the assets of any grantor trust owned by the taxpayer to be included in the taxpayer's estate, and requires transactions between a grantor trust and owner of the trust to be treated as if it was between the trust and the unrelated party, applicable only to trusts created or assets transferred after the date of enactment. Nothing that you need to worry about. Prohibits the use of valuation discounts for lack of marketability and lack of control when valuing non-business assets for estate and gift tax purposes. So a lot of complicated stuff there. It all comes down to it. Taxes will be going up very soon. And you need to be prepared for that. If you didn't catch everything that I said, I encourage you to rewatch this. If you're on Facebook, you're on Instagram, rewatch this. Take some notes. Feel free to shoot me a message at jeffbadu.com. Check out the website, jeffbadu.com, jeffbadu.com. If you have any questions, comments, if you want to check out some additional resources, be more than happy to help you out in dissecting this. One thing you do need is you need some tax planning, without a doubt. Everybody that's listening right now, you probably want to meet with your tax advisor. If you don't have one, we'd be more than happy to help you out with that. Tax planning is one of the services that we at Badu Tax Services LLC do offer, and a lot of people will be needing some tax planning, especially my $400,000 and above income earners, my doctors, my lawyers, attorneys, even accountants. Accountants need it too, right? Hey, we have clients that are accountants, believe it or not. But high income earners, people who make a lot of money in their business, you would definitely want to come see me. If you're below 400, you still want to come see us, right? We can still strategize, but understand that the 400K and above crew, that's the people that this tax reform is really going to target. So just keep these things in mind. They are really cracking down on some of these things. And so I definitely would love for you to take advantage of the things that we're talking about, taking advantage of our services. We do offer a free 15-minute consultation if you go to the website, badutaxservices.com. Once again, that's badutaxservices.com. And by the way, for those listening right now, check out the Infinite Wealth course. On Instagram, it's the second link in my bio. Type in the code INFINITE for a chance to get 50% off the course. Once again, for Instagram, check out the second link in my bio and enter the code INFINITE for a chance to receive 50% off the Infinite Wealth course. For those on Facebook, or if you couldn't catch that on Instagram, go to the website, jeffbadu.com. Once again, that's jeffbadu.com, jeffbadu.com. You can get the course at 50% off just by typing in the code INFINITE. A chance, at least. It's not guaranteed, but it's a chance to receive 50% off the Infinite Wealth course. So I know that was a lot. Hopefully you gained some value, some education. Education is everything. Some knowledge from what it is we just talked about. We'll probably do a webinar as a firm at Badu Tax Services. We'll probably do a webinar, but we'll more than likely wait until things get more solidified with this tax reform. So we may do a webinar. Right, that's still up in the air, but we might wait until something gets more solidified as far as this actually passing. So remember, if you were not able to catch this information, then I would strongly recommend that you basically, right, rewatch this. This is recorded. So Facebook, right after this, it will be posted on my page. Instagram will be posted on my IGTV page. And I encourage you to check that out. All right, we do got a question. So Pastor Kwame says, what is the deal with the $600 Cash App, P2P, peer-to-peer payments that has to be reported to the IRS? Long story short, they don't want people to be committing money laundering, right? Just money laundering or tax evasion, because there's a lot of business owners, mainly business owners, that don't report their income on their taxes. So now the IRS would have access to every single transaction that's $600 or more, basically. Right? They would have access. They can literally go into your bank account and audit you on the spot without requesting anything from you directly. And they would see if the income you are reporting matches up to what's on your tax return. Now, if you report everything accurately, you got QuickBooks, no problem. You have no problem whatsoever. Right? No problem. You do things by the book. Everything is tight. No problem. If you're one of those cash-only businesses and you're trying to evade taxes, you might end up like Al Capone. Right? That's just straight up. That's just being real. You might end up in jail for tax evasion because now the IRS would have access to your bank records. Is this feasible? Is this something that probably can get done? I don't think so. It would be way too much for the IRS to handle. They don't have the money for it. Banks would lobby like crazy because it would require more money from them unless the government wants to pay for it. The government is technically broke right now. That's why they're trying to raise $3.5 trillion from tax revenues so that they can pay for this big infrastructure and all the stimulus plan or packages that we've had. So the whole $600 rule thing, it doesn't really mean a whole lot to me. I didn't even blink. I didn't even bat an eye when I saw that. Because for one, if you're doing things by the book, you have no problem. And two, it's not really feasible. So I wouldn't worry too much about it. It will cost way too much money for the government, and it will be an administrative nightmare for the IRS, who can't even get their lives together. No pun intended, no disrespect to anyone that works at the IRS that's listening right now, right? It's a group of people that I work with every day, but I would say they're behind. IRS is behind tremendously. So to put this on their plate, I don't think would be the best use of their time nor their resources. They're very, very tight when it comes to money right now at the IRS. Right? At least money that's been allocated to them to do things such as review tax returns, issue tax refunds, stimulus checks. There's so many problems that happened at the IRS this year. Won't even get into the details. But with that, if you do need somebody to help you with your taxes, check out the website badutaxservices.com. Once again, that's badutaxservices.com. We'd be more than happy to help you out. We do offer a free 15-minute consultation, which you can schedule right on the website itself. And so with that, let me go ahead and wrap it up. So thank you all for tuning in to WJC LP Chicago 98.3 FM. You can always catch us on our website, WJCradio.org, where you can also make a donation. We are a 501c3 nonprofit organization. And so with that, my name is Jeff Badu, and I look forward to continuously and consistently delivering you all some content. Thank you.